Good evening. This is Stan Freifeld from McMillan Analysis, and thank you for those who have been here. Thank you for waiting a few minutes for me. I had some brain teasers up, and I'll give you the answers to those at the end for those who care. Well, here's the agenda for tonight. We're going to talk about something I call the beautiful equation. I guess other people call it the equation of put-call parity, or just put-call parity, aka also known as. And it's actually something that's very important for trading. We're not going to get a lot of trades out of it, but it's going to give us an understanding about how options work and how they relate to each other. I want to start out by just a couple of ground rules. First, I don't have any helper today. Typically, I have a helper who looks at the questions and responds to some of them and feeds me more at the end so I could respond. I'm not sure I'm going to be able to respond to questions as I go through the presentation, but you can be sure that any questions that you send to me, you see my email, and I'll show it again later on. It's stan@optionsstrategist.com. Any questions that you do send to me, I will respond to within a day or two. That's guaranteed. Okay. I want to first just start out by saying that trading options is a very complicated business, and I've heard numbers about how many people lose money trading, and the numbers to me are staggering. I've heard 80%, I've heard 85%, I've heard as high as 90%. The truth is, I don't know what the real number is, but I'm sure it's pretty high. And what I want to tell you is that by attending webinars like the one we're doing tonight, and others that I do, that Larry does, and that other companies and other traders put on, it's going to give you an advantage over a lot of the trading public. There are my reasoning as to why so many people lose money trading is because they just don't make the effort to really learn what trading options is all about. We have these two additional dimensions that you have relative to stock and futures, which go up and down. We have time and we have volatility. And while it's complicated, it's not rocket science. And I believe that anybody who puts their mind to it and is willing to take the time to learn how to trade can do so, and can do so successfully. So with that, let's get started. Well, let's see. Here we go. Okay, so here's an outline of the presentation. First, I have to go through a disclaimer. You know, we paid lawyers to write it, so I guess I have to read it. Then I'll tell you who I am, for those of you who don't know me. I see a lot of names here of people that I do know, some former students, some current students, and people I've met at the various trade shows. But anyway, then the next step will be to show some equations. I have some famous equations, the Black-Scholes model, and then we're going to get to what we're talking about tonight, the beautiful equation. I'll define the terms. I'm going to go through a detailed derivation of the beautiful equation. I'll give you some examples as to how we could use it and what it really means. There are lots of things that it does that we can't actually use, but in terms of keeping pricing in line and things of that nature, it's really a very useful, or as I call it, beautiful equation. Then I'll give you a summary of what we've talked about, and at the end I'll show you some specials that we have. I'll give you my contact information, and and also the answers to the riddles for those who got here early. All right, so here's the disclaimer. I always love reading these things. All right, so here we go. The presentation is for educational and informational purposes only and should not be construed as a solicitation to buy or sell options or other securities of any kind. Also, we are not advising or recommending the use of the strategies or techniques described herein. All right. There are multiple risks inherent to options trading that may expose investors and traders to potentially rapid and substantial losses. You agree that McMillan Analysis Corp, and Stan Freifeld for that matter, is not liable for any trading losses or other consequential damages you may incur. And finally, option trading is not suitable for everyone. To learn more about the risks of trading options, you could see this brochure at the optionsclearing.com website. Okay, it's called Character and Risks of Trading Options. If you go to the optionsclearing.com site, I'm sure you'll find it. Okay, here's here's Stan Freifeld up here as a former floor trader and official of the American Stock Exchange. That's a white badge. It means I was an official of the floor. Just some information about me. I started my floor career in 1994. That was after selling a pension consulting company that I was a part owner of. I was a market maker on several well-known options, and I became a floor official later in my career on the floor. What else could I tell you that's interesting about myself? Not a heck of a lot. The only thing, over here it says I live in New Jersey with my wife, son, and teenage daughter. My son is now a financial engineer, and he's out in Colorado, and my daughter's in college. So my wife and I are empty nesters, but we're still in New Jersey. All right. So let's talk about some famous equations. First, we have the equation that Einstein came up with, E equals mc squared. Probably everybody's familiar with it, although I'm sure that most of us don't know exactly what it means, but we're familiar with the actual equation. I practiced as a mathematician for a while, so to me this also is a famous equation that I think is very, very beautiful, and it's e to the pi I power plus 1 is equal to 0, and what it's saying, e is the base of natural logarithms, pi is the ratio of circumference to diameter of every circle there's ever been, I is the square root of -1, the imaginary number, I guess that's why it's I, and putting those three constants together plus 1 plus unity is equal to the null set is really quite remarkable. This, by the way, for those who care, is referred to as Euler's. It's E-U-L-E-R apostrophe S, Euler's equation. Others who might be familiar with it, like I was back in high school, might have referred to it as Euler's equation, but it's actually Euler. All right, but anyway, that's neither here nor there for what we're talking about tonight. We're option traders. I'm no Einstein. I don't practice as a mathematician anymore. So what's our favorite equation? Well, I think a lot of people, if you ask them that question, would probably say Black-Scholes, right? So let's just take a quickie look at the Black-Scholes model. The Black-Scholes model was important enough for the developers of it. There were three guys, Fisher Black, Myron Scholes, and Robert Merton, who won a Nobel Prize in 1997. It was the Nobel Prize in Economics. And that really opened the door to derivatives trading in a really big way. And when it first came out, it came out earlier than the 1997. That's when they won their prize for it. But it was only based on calls. So we had the call theoretical value, and then it was equal to this formula here. Now, for those who are not mathematicians or haven't seen this maybe in a number of years since college days, it might look pretty pretty tough to decipher what it's really saying. And it was tough to come up with this equation, but actually using it and programming it into a computer is relatively straightforward and easy to do. So the variables that we need are stock price, exercise price, and I always use X for exercise price. A lot of people use K in here for strike price. The risk-free rate, time to expiration, and volatility. Those are the 5 variables that were originally needed to calculate the value of a call, the theoretical value, TV, of a call. And dividends were added later on. The original Black-Scholes model did not incorporate dividends. So here are some of the assumptions that were in the Black-Scholes model. The options are European exercise as opposed to American. I'm sure most of you know what that means. European exercise means the options could only be exercised at expiration. American style options can be exercised at any time. The same goes, of course, for assignments. If an option can be exercised, it means if you're short, you can be assigned. You can't be assigned early on a European exercise option, only on an American style. All right. Another one of the assumptions in the Black-Scholes model is that the interest rate is constant and continuously compounded through expiration. Volatility is constant. The option is continuously hedged. That's a very interesting one, and it, when you think about it, it makes the concept of volatility particularly important. There are some who would say that if an option isn't hedged, then it really doesn't have any volatility. And what does that mean exactly? Well, volatility is one of those subjects that sometimes people think they really understand it, and that same person 5 minutes later would say, gee, I don't really get it. It kind of, the knowledge base goes in and out. And so, it gets pretty deep when you think really about what volatility means. Anyway, the original Black-Scholes model had no provision for dividends. Adjustments were made to the model later on so that now you could use it in situations where there are dividends. Okay? All right. Well, Black-Scholes could have been a good choice for your favorite equation, but my favorite equation relative to options is the one of put-call parity, and that's why I call it a beautiful equation. So what it is, and we'll see everything defined more precisely on the next page, but what it does is it tells us the difference between the call and the put. It's very different than Black-Scholes. Black-Scholes tells us, based on a set of assumptions, what the theoretical value of the call is and what the theoretical value of the put is. And you might think, gee, that's really very important. As you're going to see, and as maybe you know already, the theoretical value isn't that important anymore for retail traders. I mean, it's always good to know what, to get a sense as to what the theoretical value is, or at least approximately what it is. But what's going to be more important for us, retail traders, is the relationship between options. And so just to, well, I guess I already said it, but we could have this as being equal to 5. Black-Scholes could tell me this is 5 and the put is equal to 3, something like that. Well, if the right-hand side of the equation is equal to 2, and all we had is this beautiful equation, we don't know that it's 5 and 3. It might be 7 and 5, or 2.9 and minus 0.9. It just tells us the difference between the two. Now, the assumption is that the options, for this formula to work exactly, the options have to be European style. And as you know, most options that trade in the U.S., all stock options, are American style. So right away, do we have a problem? Well, not a major problem. The issue comes up when there's an early I used to be an actuary, so I think early retirement. When there's an early exercise issue, and early exercise is an issue for calls when there are dividends, and for puts typically when interest rates are relatively high. Right now, as you know, interest rates are relatively low, and the early exercise feature is not too much of an issue. It doesn't throw off our formula very much, but keep in mind that it is there. It is something to be aware of. Here's the terms for the beautiful equation. So C is equal to the call premium, P the put premium. That's pretty obvious. S is the stock price. X is the exercise price or the strike price. I think I already mentioned that some people use K instead. Then we have, it's not shown directly in the formula, but we're going to need it to calculate the I term, T and R. T is the amount of time to expiration expressed in years. So if 1 month would be, you could think of it as 1 divided by 12. What you could use whatever units you have, but you have to put the time to expiration in years. What I mean by that, if it's weeks, 2 weeks, you'd have to take 2 weeks divided by 52, or days divided by 365 to turn it into a portion of a year. And R is the risk-free rate of return. Just to give you a feel for what that is now, I've been using 15 basis points. That's 0.15%. It's pretty close to zero. But I see the 3-month T-bill now is about 0.34%. I'm going to increase my risk-free rate of return, the one that I use in my own trading, to 0.35. It's not something that I change very often, and with the rates as low as they are, it really doesn't matter all that much. There's not much of a change. But, just so you know, interest rates used to be obviously a lot higher. I was trading on the floor. I think when I went down there, interest rates were 5 or 6%, but they went up to 10 and 11% at the time that I left, which was 9/11, actually, 2001. So, interest rates, at the time, people were on the floor was saying, gee, interest rates could never go back down. And I remember thinking at the time, that doesn't really sound right. Interest rates have always been relatively cyclical. And so my point now is that interest rates at some point will probably rise up again. I'm not saying when. I don't need to do that for my options trading. But that's probably what's going to happen. Anyway, so we have this I term now, and I is equal to interest, and we're going to define it, or derive it actually, you'll see later on, as XRT. And a question that comes up all the time is, why are you using X, the strike price, and not S, the strike price? Well, we'll see that. And D is the present value of dividends that go X prior to the expiration date of the option that we're looking at. Okay? All right, so now we know what it is, what the beautiful equation is. Let's see how we could derive it. Where does it come from? You don't want to just take my word for it, do you? Okay, so here's what we're going to do. We're going to put on a position of long 100 shares of stock, my favorite stock, XYZ. We're going to buy 100 shares of that. We're also going to buy a put at some strike. We'll just strike X. And we're going to sell a call at the same strike X, of course with the same expiration date. Okay. Now in my usual notation, as I go through my mentoring program, I would normally put it like this: long stock plus long put plus short call, or we transfer the L to positive signs and the S to a minus sign, I could just say stock plus put minus a call. All right. Now this particular position is referred to as a conversion. I'll show you why in a minute. The other side of the trade, if somebody was selling stock or shorting stock, selling a put and buying a call, that's the other side of this position, and that's called a reverse conversion, or for short, people just refer to it as a reversal. Now, why is this called a conversion? Well, it's because any two of these legs, if we call this the three parts of it a position, then we have three legs, the stock, put, and call. Any two of them convert with the third. And you have to understand about synthetics, which I'm not going to talk about too much tonight, but long stock and a long put synthetically is a long call. So these two, long call, convert with the short call. Then we have long stock and a short call. Probably a lot of you are familiar with that. Synthetically, that's the same as a short put. The short put converts with the long put. And then finally, a long put and a short call is equivalent to short stock, and that converts with long stock. So any two of these convert with the third into a flat position. Okay. Now let's say we put something like this on. What happens at expiration? Okay. Well, on Friday prior to expiration, we just have our position. We have our long stock, our long put, and our short call. Three things could happen at expiration. The stock could be greater than the strike, the stock could be less than the strike, or the stock could be equal to the strike. Let's look at the first situation. The stock is greater than the strike. What's going to happen? Well, we have the long stock. The long stock is just long stock. But the long put is now going to expire. It'll expire worthless. That's the zero over here. And the short call is going to be assigned. The other side of the position is going to exercise it because the stock is greater than the strike, and so will be assigned. And when we have long stock and the assigned call, which would give us the equivalent of short stock, right? When we have long stock and short stock, we're going to end up Monday morning flat with no position on at all. Okay? We're going to have some, we're not talking about cash, we're just talking about options and stock. Okay, what if the stock is less than the strike at expiration? Well, again, we have our long stock, and the put now is going to be in the money, so the put will be exercised. That gives us the right to sell stock, or it would, if we didn't have any position, we'd get short stock from it. In either case, the long stock plus the short stock will net out to a flat position, and the short call will expire worthless. So again, whether the stock is greater than the strike or less than the strike, we're going to end up with a flat position on Monday morning, or no position. Excuse me. Now, what if the stock is trading right by the strike price? Then we might have a little bit of an issue. And for those of you who are familiar with this, it's referred to as pin risk. Okay? The stock is being pinned to the strike, and there's reasons why that could happen. Well, let's take a look at how this might cause us a little difficulty here. We have our long stock, and then the long put, which is the one that we have control over because we're long. Let's say we decide not to exercise it, and we end up not being assigned on the short call. We're going to wake up Monday morning with long stock in our account. That's not particularly a good thing, because if you end up with a position that you didn't want to have on, the option guards typically are not very nice to you. So the stock may be, the stock might go down in that case. Of course, you could be lucky, it might go up. But the real bottom line is we don't want to have a position that we didn't want to have. So that's not good. On the other hand, suppose we say, okay, maybe we should exercise our put. It's a penny in the money. In which case, by the way, it would be exercised automatically unless we said we didn't want to exercise it. Or even if it was right at the money, we might say, gee, we want to exercise it. Some would exercise a penny out of the money if they were expecting something to happen over the weekend. Anyway, for whatever reason, we decide to exercise the put, and we're assigned on the call. So now the long stock cancels out with one of these, either the exercised put or the assigned call, and we're left with the other one, which either way will give us short stock. So again, we're going to end up with a position Monday morning that we really didn't want to have. And so what I suggest, we're not talking about how to handle these positions right now. I'm just talking about the derivation of the beautiful equation. But if you have a position like this on, I would suggest that you take it off by expiration of Friday expiration. You could do it close to the close. And because the stock is trading right by the strike, the price of the options will be very minimal. You won't have to pay a lot to buy back your call, and you'll be able to sell your put at for a good price, or well, basically you're not going to get much for the put at that point. But the market makers will let you out of that kind of a position at relatively good prices. So, all right, but we're looking at the situation where the stock is either greater than the strike or less than the strike, because this one we would get out of before the actual expiration. Okay, so whether the stock is greater than the strike and the call is assigned, or the stock is less than the strike and the put is exercised, you'll need to sell 100 shares of stock, and that's going to be at the strike price, which is X, right? So we're going to have X times $100 coming into the account at expiration. I hope that makes sense. If anyone has questions, they could they could ask, and I'll see if I could answer them later on. Or like I said, certainly we'll answer them in the next day or so, individually. All right, now there's one more piece of information that we need to be able to put this thing together, and that's the present value of money. And this is an important concept, not only for options trading, but just for any financial type transaction. And what it's saying is money has different values based on the time when it's either being paid or being received. So for example, let's say you owe $1,000 payable in 1 year. And let's say we're in a 3% environment. As I said earlier, we're not there now, but let's assume that we were. Then the present value of that $1,000 would be 1,000 divided by 1.03, or $970.87. And what that means is if I owed somebody $1,000 1 year from now, if I gave them $970 today, $970.87, that would be equivalent, because they would take it, put it into this risk-free investment that would earn 3%, and at the end of 1 year, they'd have the $1,000. Okay, so it would be a way that you could extinguish a debt or just transfer money at different times than when it's actually due to be paid or received. All right, now assuming continuous compounding, the general formula is more like this. This looks a little more complicated, saying the present value of X, X being the amount of dollars, is equal to X times e to the power negative RT. Okay, this is referred to as a present value factor. In this case, it would come out to 970.45. And the way that we're actually going to do it, and I think the way that most places do it, is we end up using what the equivalent is of simple interest. And if anybody cares, by the way, we get from this continuously compounded formula to this formula over here using something called the Taylor expansion. Again, probably a lot of you learned it years ago and nobody knows it now. If anybody is interested, though, just shoot me an email and I could send you some more information about it. But so the approximation that we use for the present value of an amount of money is that amount of money, X minus X times R, the interest rate that that we're discounting at, times T, the amount of time in years. In this case, the 3% for 1 year, the present value of $1,000 would be $970. Okay? All right, that's what so we need to understand the concept of present value of money. All right. Well, now that we have that, we could take a look at, we could make a timeline actually and look at cash flow. This is time 0, and this is expiration over here, expire. And we have the stock, the put, and the call. They're all at time 0. But it's not until expiration that we have this money that's coming into our account in the conversion situation that I assumed. So this X dollars, which is really the strike price, this is payable at expiration. Now, if we want to look at, we can't say that they're equal because they're at different points in time. So if we wanted to compare them, what we'd have to do is look at everything at expiration, meaning we'd use a forward value of stock, put, and call. Or what's much easier to do is to use a present value, because all we have to do is take the present value of one amount as opposed to a future value of 3 amounts. So we're going to bring this back here, and the value is not X anymore, it's now the present value of X. Okay? All right, so now we have everything as of the same time, and the money that's going in has to equal the money that's going out, the cash flow. And so we could say the stock plus the put minus the call, that's what we have over here, has to equal the present value of the strike price. We could rearrange that very easily and just get call minus put is S minus PVX. Okay? And then from the prior slide, this is what we have. Call minus put is stock minus the present value of the strike. We already said that we could substitute for the present value of the strike X minus XRT. So I'll put that in here and rearrange and come up with call minus put is stock minus strike plus XRT. And then how do dividends fit into this thing? Well, what's really happening is the present value of the dividends is coming out of the stock, where we're saying the stock is reduced by the present value of the dividends. There might be 1 dividend, there might be 2, there might be no dividends, but whatever it is, we'll take the stock minus the present value of the dividend, and then just rearranging the whole thing, we'll get call minus put is S minus X plus XRT minus PVD. And we've already defined this term, the XRT term, as I, right? And we said we're going to use the present value of dividends. We defined that earlier as just equal to D. Okay. Now, by the way, in practice, I know some people, when they calculate the present value of the dividend, because the dividend is small relative to the stock, well, it's always small relative to the stock, what they do is they would just use the dividend amount as opposed to taking the present value of it. Because if you think about it, when you subtract out, you know, the present value of the dividend would be D minus DRT. Well, if D is 20 cents or 50 cents or some low number relative to the stock, and then R and T are going to make this subtractive term very small, it's almost equal to D. So some people just use D, particularly in today's environment where the rate is so low. On the other hand, you know, I feel that what the heck, if you're putting it into a computer program, an Excel spreadsheet or something like that, the computer doesn't mind the extra work. Okay? But anyway, so that's how we get to the beautiful equation. That's the derivation of it. All right, so now we know what it is, we believe it because we saw how we derived it. And let's take a look at what it's going to tell us. So we'll look at my favorite stock, XYZ, trading at 57 with no dividend. And let's say the April 55 call is trading at 550. We'll assume there's 80 days to expiration, and the risk-free rate is 5%. I'm using 5% just as an illustration because if I used, what it really is today, 34 basis points or something low like that, you wouldn't really see the impact of interest, where in some cases it can have a relatively large impact. All right, so we calculate the I term. It's the 55, the risk-free rate of 5% times 55 for the period of time, which is 80 days divided by 365 days. Comes out to a nice round number of 60 cents. And then we plug it into our equation. Remember, the dividend was 0. We said no dividend up here. All right, so the call is 550. We're solving for the put. The stock is 57, the strike is 55, and the interest is 60 cents. We solve the equation for P, and we get the put should be trading at 290. Okay. Now, alternatively, suppose we knew the put was trading for 290, we could solve for the call. And we do it the same way. First, we calculate the interest term. Well, the interest term isn't going to be any different. It's still the 60 cents. I doesn't change. And so we put it into our equation, and we get now the call is equal to 550. Okay, so we know that based on the assumptions that we have, the call and the put are trading for 550 and 290 respectively. What if they're trading at some other price? These are theoretical prices. Well, what if they're trading at some other prices? What does that mean? Well, so with the stock at 57 and the 55 put at 290, we know the call should be trading at 550. But what if it's not? Okay, so if it's trading for more, suppose it's trading at 575. The put is still 290, but the call is trading at 575. What we're saying is that relative to the put, the call is priced high. Or maybe it's the other way around. Maybe the put is priced low. Call is high relative to the put, or the put is low relative to the call. We don't really know what the right price of either option is because we didn't use the Black-Scholes model or any other pricing model to tell us exactly what it is, but we know where it's actually trading. Anyway, if it's trading for more, so the call is trading for 575, what we want to do is sell the call and buy the put. Now, of course, if it's trading for less, what we want to do is buy the call and sell the put. We always want to buy the cheaper one and sell the more expensive one. When we do that, we could lock in the difference. In the case that I mentioned of the call trading at 575, we'd be able to lock in 25 cents with in this case, what we'd have to do is buy stock because we sold the call and we're buying the put, so that would be the equivalent of short stock. Now, that's not something that we're going to be able to do on a regular basis. It's called a conversion. I will tell you this. Years ago, traders, I should say, traders used to make their livings just trading those conversions and the other side of the conversion, the reversal. There's a little bit more risk in the reversal because you have to short stock, and as I'm sure everyone here knows, shorting stock isn't always possible. But anyway, conversions and reversals are not very popular now. They're actually quite rare. But so why am I telling you about that? Well, the interesting thing about it is, remember, if the call was 575, think about what's going on here. And the put is 290. We know the difference here is 260, right? 550 minus 290, call minus put is 260. That's what it should be. But it's actually 575 minus 290. So there's 25 cents. The call is 25 cents higher. What's going to happen when people come in and realize that they could lock in some profit, they could lock in that 25 cents by selling the call, what's going to happen to the price of the call? It's going to go down, right? This price is going to go down, and they're going to buy the put. So what's going to happen to the price of the put? The price of the put will go up. And by this coming down, the call going down, the put going up, we're going to reach the equilibrium level of 260 where it should be. Okay? Now, that's why in today's trading, the markets are generally pretty much in parity with each other. The call and the put and stock all seem to trade very well relative to each other. But there are occasional lapses, and sometimes, I hear stories about someone putting on a conversion or reversal for, for a small amount. But that position, by the way, has very little risk. I'm not saying it doesn't have any risk, because I know I could, we could always find risk in anything, but it has very small amount of risk in a conversion. Or a reversal, for that matter. Okay, now here's an example of how this was actually used in a particular situation. As you know, Larry publishes really 3 different newsletters, and in one of them, this was I changed the name of the stock from what it was to XYZ, but anyway, in one issue of the Daily Volume Alerts, Larry recommended to buy 10 of the XYZ August 7th calls at $1.40 or less. So I take a look at what the pricing is, and this is what I see. The stock is $8.30. There's 9 days to go to expiration, and the call is bid $1.40 and offered at $1.50. On the other side of the aisle, we have the put at a nickel bid offered at 10 cents. Now, obviously, we can't buy the call for 40 cents, right? That's where it's bid. If we wanted to buy it, we'd have to pay $1.50, or we could try and work it. Maybe we could do something a little better, or maybe we could keep it in all day, and who knows, maybe our bid would get hit and we'd end up buying it. But based on what it looks like, it doesn't seem that we could buy the call for the price that Larry was recommending. Anyway, let's take a look, though, using what we know. And at the time, this wasn't very recent, but at the time, the risk-free rate was about 2%. So I just calculated the amount of interest here, 7, that was the strike price, times 2% for 9 days, came out to 0.003. That's effectively 0. Right? It's less than a penny. So then we have our beautiful equation. We put in the price of the call as $1.40, and we solve for the put. So $1.40 minus P is equal to $8.30 minus 7 plus 0, the amount of the interest, and we solve that, we get the put is equal to 10 cents. So although we weren't able to buy the call directly for $1.40, what you could have done in that situation, and I don't know if you think it's worth it or not to do this kind of manipulation. There's commissions involved and some other issues. You're using up a lot of your trading capital. Well, depending on how many times you do it. But anyway, you'd be able to buy the put for 10 cents, and then and with that buy stock, and that would be equivalent to getting the call for $1.40. Even though when you take a look at the actual market, it was offered at $1.50. So we're getting it for 10 cents better than than what we'd actually have to pay for it. And you have these situations from time to time where you're able to do better than what a recommendation is by looking at it from what we call a synthetic perspective. And that's exactly what happened in this case. All right, what else does our beautiful equation do for us? So far we saw that it's keeping the pricing in line, right? We saw it made the call price go down, the put price go up when they were out of line with the call being higher than the put. What about synthetic positions? Now, I'm not going to talk, like I said, very much about synthetics tonight, but anyone who's a serious options trader should really understand how synthetics work. Probably the one that here's an example, probably the one that most people are familiar with at this point is that a covered call and a short put are really the same position as far as the amount of gain or loss that they'll make, not the yield. Obviously, a covered call is long stock and a short call. That's going to be a lot more expensive than a short put. So percentage-wise, the results will be different, but dollar-wise, the results should be very close to the same thing. Anyway, what does it mean when we talk about these synthetics? Well, two positions are synthetically equivalent if their risk profiles are the same. So a covered call, long stock, short call, and a short put really will react the same way. And that wasn't always a well-known fact for traders. I think today it probably is. But years ago, there were court cases where situations where a covered call would be considered a conservative position and a short put a very speculative, aggressive position. It took some good witnesses to prove that these really were the same thing. You had issues where somebody was put into a covered call and which apparently made sense for that particular person, but if you asked the broker, would you put that person into a short put, his answer would be no, that would be too speculative. And then once you showed that they were the same, guess who won that kind of a court case? Anyway, based on what we have, based on our beautiful equation, we could manipulate it and come up with the 6 basic synthetic positions. So, well, here they are. Call minus put. Long call, short put is equal to synthetic stock. Long call, short stock is equal to a put, to a long put. Put plus stock is equal to a call. That's another one that comes up a lot. I don't think people are as familiar, traders are familiar with this one as they are with the covered call and the short put. But that's an important one. Well, they're all important, but that's a common one that comes up. Long put, short call is equal to short stock. Stock and a short call is equal to a short put. That's our covered call. And then short stock and a short put is equal to a short call synthetically. In fact, what I used to do, I used to put a little S above each of these to show that they're synthetically equivalent. They're not identical. If you put numbers in, it's not going to work, right? If you have a $3, just looking at this, a $3 put and a $3 call and a $50 stock, 3 plus 50 is not equal to 3. So now, why are the synthetics important? Well, sometimes it's more advantageous to put a position on one way as opposed to another way. That's certainly one reason why you need to know your synthetics. But also, it allows you to see and evaluate the amount of risk that you have in a position. So if I have a position, for example, that has stock and a put in it, I could just say, gee, this is really equivalent to a call. And in fact, it might be easier to think about the risk associated with just a call as opposed to 2 legs, stock and a put. So that's that's how you could use this kind of thing in your actual trading. Also, you might say, gee, if I have stock in a put, I could probably take money out of the position by selling the stock, selling the put, and buying a call. So there's a lot of manipulation that you could do once you become familiar with these synthetics. Okay, so here's a summary of what we have and what the beautiful equation could do for us. It's going to help us see and evaluate the amount of risk in a position. There's opportunity for arbitrage profits, which were those conversions and reversals. Now these days, well, they do come up occasionally. It's rare for retail traders. What ends up happening is when they show up, the market makers take advantage of them right away because the market makers don't have any real expenses, certainly not the way we do as retail traders. So something that where you might see an arbitrage lining up for 4 cents, 3 or 4 cents, you might say, well, it's not really worth it between the commissions for putting the position on and taking the position off and the margin issues. It's just not worth it. Well, a market maker would snap it up without even thinking about it. So it's not very often that we see it as retail traders. I find them once in a while when I'm looking at something that doesn't trade very much, that has a relatively wide spread. Let's say something that's a $2 bid. I'm making up some numbers. $2 bid by $2.50. And we know, gee, if we could buy and let's say these are calls, if we could buy the call for anywhere less than $2.30, we could lock in, we could lock in an arbitrage. And then all of a sudden you're watching it, and out of the blue, the $2.50 offer goes to, somebody comes in with a $2.20 offer. And then you see it, you're right there because you've been looking at it, and you grab it sometimes before the market maker. And that's how you could lock it in sometimes. Anyway, another issue is it keeps the pricing of puts and calls in line with each other, and that's probably the most important thing about the beautiful equation. I want to point something else out about call minus put, S minus X plus XRT minus D. Sometimes when I'm going through the mentoring program, I'll ask a student, what happens to the call or the put as interest rates change? As interest rates increase, for example, what happens? Well, we have the R term here. It's the only place in this equation. Everything else being constant, just the risk-free rate increases. Well, the right-hand side of this equation is going to increase, right? And so how could that happen? Well, the call could go up or the put could go down. Either way will increase. It's just an easy way to think about what happens when the variable R changes. Or what about D? A company decides to increase their dividend. So what happens to the right side of our equation? Well, the right side is going to go down. Well, how could that happen? Well, the call could go down or the put could go up. So an increase in the dividend amount will increase puts and decrease calls. And it's just an easy way to look at it. Another thing I should point out to you is there's no V term. The difference between this and the Black-Scholes model is there's no volatility term in here. And what that means is that, well, I don't want to get into the Greeks, but what that means is that if volatility changes, the call and put will change by the same amount, and therefore, I go through a more formal proof in the mentoring program, but therefore, the vega for a call and put has to be the same. So there's a lot of information that we could get from this equation. And what else? So the last point here is that using this will also allow you to make a position smaller. And that's what I was talking about before. For example, if you're long stock and short long stock and short a call, you could replace that by with a short put, and it allows you to take some money out of the position. I'm not saying profit necessarily. Don't misunderstand that, but it allows you to use that money now that you've taken out of the position that you had for some other purpose, putting on another profitable position, hopefully. Okay, so all right, I just want to talk a little about our company, about McMillan Analysis, and show you some specials that we have, and then I'll see if I could answer some of the questions. I see a bunch have come in, and we still have a few minutes left. So McMillan Analysis, we provide many products and services. There are trade advisories. We have 3 different ones. We do money management if you'd like somebody else to do the option trading for you. We have a lot of educational material and software products. And these 2 here, these are really what I specialize in. I do consulting projects to institutions, hedge funds, and individuals. And I run a one-on-one mentoring program. So if you're interested in any of these things, you could visit our website or you could call me directly. I always like talking to traders. For those of you who've come here tonight to listen to me, if you want a copy of the PDF file, you could get that. Obviously, it's free, and we also have some whopping discounts, 50% off on several products that I think would make sense relative to what we were looking at today. You could check them out at our website, optionsstrategist.com, and then /BE, guess what? Beautiful equation. Okay. Oh, and here's something that could be very useful to you. We've arranged for free 30-day trial subscriptions to the following software products. Now, Option Workbench was developed by a former student of my mentoring program. It's a terrific product, and you could get a 30-day trial. We've always had that, but what's relatively new is I've negotiated a program with OptionView where you could have a 30-day trial. They typically give, I think, 2-week trials, 14-day trials. For our attendees and our customers, they could get a 30-day trial. Both of these are terrific software products. You know, why not take a look and give them a workout? Doesn't cost you anything to try them. And finally, if you're interested in the one-on-one mentoring program, you could come to the website and click the mentoring tab, or you could just call me directly. Like I said, I like talking to option traders, particularly about options, but it usually extends to a number of other topics as well. And here are the answers to the brain teasers. Sometimes I end up getting more questions about that than the actual material. But if you have any questions about these, or if you disagree perhaps with my answers, or you want to see solutions, again, just drop me an email. I'd be happy to explain them. And here's the contact information. This is my direct line, my office line. My email is my name, stan@optionstrategist.com, and the special deals are available at optionstrategist.com/BE. All right, now let's see. Let me see if I could respond to some of these questions. Oh, gee. Somebody asked if I could go back a screen. Well, the full PDF file will be available. Yes, it is being recorded. Someone's asking what about synthetic stock. Synthetic stock is a long call and a short put. If you buy a call and short a put, and of course there'll be some margin issue from the short put, you will make or lose the same amount as if you bought stock. Now, of course, the synthetic position will expire and actually turn into to actual stock. If the stock is above the strike, the call will, you'll exercise the call and you'll end up with stock. And if the stock is below the strike, you'll be assigned on the put, and being assigned on a short put actually gives you long stock. So that's synthetic long stock. Synthetic short stock would be a long put and a short call. Okay. If you have more questions about it, you could send me an email, like I said. How do you subtract the call? Well, when I'm using the term subtracting the call, what's actually happening is it's a short call. So you're buying a short call, or you're actually, I shouldn't say you're buying. You're selling a call. That's that's what that negative sign meant in that situation. Would be. Okay, somebody here is just somebody picked up the fact early on that volatility was not part of the formula. Yes, yes, you are correct. It means Goldman would be arbing them back into line. Yeah, you don't need Goldman to do it. This gets done by traders on the floor all the time, or at least when I was on the floor. Maybe now it happens more quickly. Somebody mentioned Wade Cook. I don't want to say anything about Wade Cook. He did well. Okay, yeah. Isn't a short put a hedge? I don't know exactly what. Oh, if you already own the stock. If you already own the stock, no, actually, a short hedge is a positive delta position. You'd probably want to buy. The put on long stock would be a long put or maybe a short call, but I don't think you'd want to use a short put. Calls increase in value, puts decrease. Okay, that's true. See, it's hard. I'm not sure exactly what that went with. Let's see whether to buy. Thank you. You're welcome. Is there a way to screen for conversions? That's a very good question. And there was a company, actually. I don't recall the name exactly. It was something like Avisaram. That's probably very close to it. And they had software that was free, which I had a subscription to. And then they started charging for it, and I was able to, I had other software, so I didn't really need it. But then they came out with a conversion reversal scanner. And so I then ended up taking a paid trial to the software, and I found a few, but they weren't worth enough to make it worthwhile for me to continue it. Now, I did have a student who found a very nice conversion on Amazon, actually, surprisingly, because typically you don't find it on stocks that are relatively liquid, where there's a lot of options trading. But he did find one. He showed it to me, and he locked in. He was afraid to do it too large because he wasn't familiar with it too much. But he ended up locking in about $200, having to hold the position for a couple of months. But with, like I said, very little risk. All right. How intrinsic value? Okay, someone's asking if the present value of the strike changes, how is intrinsic value determined? And I think once you put the options on, yeah, then you don't have to worry about it anymore. That's, if I buy the 50 strike or sell the 50 strike, it doesn't matter where the stock goes. That's the strike that I have my position on. Okay. Someone said they tried to download the PDF. Yeah, wait until tomorrow. I think tomorrow everything should be online. I know I sent it into the office relatively late this afternoon. Now let's see. Okay, and somebody, well, I tried to explain this. Maybe I didn't make this clear enough, but somebody's asking where Larry wanted us to buy a call at $1.40 and we'd have to pay $1.50. We solve for the put, which was 10 cents. Okay, and then the question is, what trade would we put on? The trade that you could put on if you wanted to actually follow the recommendation and get the equivalent of the call for $1.50 would be to buy stock and buy the put, because as we know from our synthetics, long stock and long put is equal to a long call. So in this case, the put is trading cheaper than the call, so we could buy the put and then convert it into a call by buying stock. Okay. All right. Looks like we've gone past our hour, and also the questions that I see here are have been responded to. So again, thank you all for stopping by and listening to me. And I plan on doing more webinars in the future, and I hope you'll be able to attend. Have a good evening, and thanks again. Bye-bye.